Hey friends, hope you all are doing well and taking great care of yourselves. In this video, we are going to discuss the nitty-gritties of joint development agreement. We are going to discuss this from the angle of landowner. Now, let's take an example. I have entered into a joint development agreement with a developer. I am owning a piece of land. A developer is going to construct a superstructure on that particular land, or he is going to develop the land. The consideration for executing a joint development agreement would be number A, 100% in the form of cash, which will be paid to me. B, it would be paid partly in cash, partly in the form of share in the constructed property. C, it would be 100% in the form of share in the constructed property. Certain 100%, the entire share would be certain percentage of the constructed property. That's what I wanted to say. Nothing, no cash element. The next iteration would be certain percentage of the sale proceeds from the sale of the developed property. I might be holding this land as a capital asset. What would be the situation? What would be the tax consequences? I might be holding this land as stock in trade. What would be a tax consequences? What would be a tax consequences if this land which we are discussing is a rural agricultural land? So all these issues we are going to discuss. We are also going to discuss in those cases that when we can say the transfer is said to have taken place, what will be the year in which the income shall be chargeable to tax. Number 3, what is going to be the full value of consideration? What shall be the cost of acquisition? Up to what year indexation would be allowed? And what shall be the entitlement of exemption under or deduction under section 54, 54F, 54 EC, etc., etc. So all those issues which we are going to discuss in this particular video. Now, let us first discuss that I am holding a land as a capital asset. So, if I go to section 45, subsection 1, they say that 3 conditions are required to be satisfied. There should be a capital asset, there should be a transfer of the capital asset, and there should be a gain arising on account of transfer of capital asset. Meaning thereby, one of the most important condition that needs to be satisfied is there has to be a transfer of a capital asset. Unless otherwise there is a transfer, there cannot be a capital gain. I am aware that section 45(5)(a) has been incorporated in the statute, but then it will be applicable only in certain circumstances. If we do not meet the conditions given under 45(5)(a), then once again we will be outside of that. So we need to discuss the way the law stood prior to inserting section 45(5)(a) and the way the law stands after section 45(5)(a) is in the statute. So we have to discuss it from both the angles. So right now we are discussing the law assuming that there is no section 45(5)(a), and even when we discuss section 45(5)(a), we have to keep in mind that if we do not comply with the conditions given in section 45(5)(a), we would be once again taken to the old law, the law which we are currently discussing. So yes, I am aware if I am an individual and I meet the conditions given in section 45(5)(a), then today my taxability would be governed by section 45(5)(a) so far as I am holding this land as a capital asset. But if, let's say, I do not meet the condition of section 45(5)(a), let's say I am not an individual, I am a partnership firm, let's say I am not an individual, I am a company, then 45(5)(a) will not be applicable to me, and if 45(5)(a) is not applicable to me, then I will be governed by the general or regular provisions of the income tax. So now let us understand one by one that I am holding a land as a capital asset. Now department invokes, when I execute a joint development agreement, department invokes section 2 clause 47 subclause 5. Now section 2 clause 47 subclause 5, section 2 clause 47 deals about transfer, talks about transfer. Subclause 5 says that any transaction involving the allowing of the possession of any immovable property to be taken or retained in part performance of a contract of the nature referred to in section 53A of the Transfer of Property Act. So if I enter into the contract of the nature referred into section 53A of the Transfer of the Property Act, then transfer is said to have taken place. So if I enter into let us first discuss what are the conditions given under section 53A of the Transfer of the Property Act. What are the conditions that are required to be met for the purpose of ensuring that we are falling in section 53A of the Transfer of Property Act. There should be a contract for a consideration. So yes, when I enter into a joint development agreement which says that I'll be getting certain percentage share in the developed area, though I will be getting in future, or let's say it may say I'll be getting 5 crore rupees, maybe in future, maybe some amount today. Let's say it might be saying that I'm getting certain percentage of the sales proceeds of the developed area. So yes, there should be a contract for a consideration. So yes, it is a contract for a consideration. It should be in writing and it should be signed by the transfer. It should be signed by basically by both the parties. It should be signed. It should be pertaining to transaction of an immovable property. Yes, it is pertaining to an immovable property because what we are transferring, what we are talking about land which is given under a joint development agreement. The transferee should have taken the possession of the property, and the last is the transferee should be ready and willing to perform his part of the contract. So if this all conditions are being met, there should be a contract, it should be in writing, it should be in relation to an immovable property, it should be for a consideration, and next one is that the possession has been handed over to the vendee, and the vendee should be performed, or the acquirer, the purchaser should be willing to perform his part of the contract. Then section 53A gets triggered, meaning thereby when I enter into a joint development agreement, the year in which I enter into a joint development agreement, department would invoke section 2 clause 47 subclause 5 and would say that transfer is said to have taken place. Here we have to first go to the first judgment, or I would not, the first judgment is not a correct word to say, but the landmark decision of Bombay High Court in the case of Chaturbhuj Dwarkadas Kapadia. In that particular case, they have said that if you are executing a joint development agreement whereby you are handing over the possession and complete control over the property to the developer, then transfer is said to have taken place in the year in which the possession has been handed over by you. You need not to wait till substantial satisfaction or substantial compliance of the conditions subject to which the transfer is handed over. Once you have handed over the you need not to wait till satisfaction of substantial compliance of the conditions subject to which the possession has been handed over. Once you have handed over the possession, once possession has been handed over, matter comes to an end. Once possession has been handed over, in that particular case, joint development agreement is executed, possession has been handed over, transfer is said to have taken place. Once complete control over the property has been handed over by the landowner to a developer, transfer is said to have taken place. That's what has been held in the case of Chaturbhuj Dwarkadas Kapadia by Honorable Bombay High Court. This decision was also followed in the case of Dr. Dayalu by Honorable Karnataka High Court. However, then we have one judgment in the case of Jasbir Singh Sutaria. In that case, they have said that you enter into a joint development agreement today, but you are not executing or you are not handing over the possession today. Rather, you are only allowing the developer to take certain approvals from the concerned authorities. Now, this developer is taking all approvals on your behalf, and after those approvals are being taken, you are handing over the possession by executing a general power of attorney in favor of the developer. Then the year in which this general power of attorney is being executed, that would be considered as the year in which the transfer is said to have taken place. So based on this, what I understand is, if I enter into a contract of the nature referred to in section 53A of the Transfer of Property Act, transfer is said to have taken place. Now, what are the conditions? Once again, I am referring to those conditions. It should be in relation to an immovable property. So, yes, land is an immovable property. Number 2, it should be in writing. Yes, my agreement is in writing. Number 3, the third important part, that it should be signed. Yes, it is signed. Number 4, it should be for a consideration. Yes, it is for a consideration. The purchaser has taken the possession of the property. Yes, purchaser has taken the possession of the particular property. And next one is purchaser is willing to perform his part of the contract. So if these conditions are met, the transfer is said to have taken place. This is what the view which has been taken by the court. So if we look at once again the judgment of Chaturbhuj Dwarkadas Kapadia or Dr. Dayalu in case of Karnataka High Court, they have said that once you handed over the possession and complete control, transaction is said to have taken place. Jasbir Singh Sutaria said that, boss, you have entered into just a development agreement, you have not handed over any kind of a possession, but simply you have authorized the concerned developer to take certain permissions. the permission could be, let's say I have got a residential house, the developer wants to convert that premises into a commercial, he wants to demolish the building and wants to go with the commercial construction of commercial complex. So he has to take the permission from the change in use, he may have to get the plans approved. So all those activities are to be done by me. He has to take various permissions. So he is taking all those permissions and he is taking all those permissions on my behalf. So when he is taking permission on my behalf, it cannot be considered that I have transferred the premises to him. And in that case, section 2 clause 47 subclause 5 cannot be said to have been invoked. Meaning thereby, if I enter into a joint development agreement and conditions of 53A are satisfied, then transfer is said to have taken place. Now, if I want to come out of this, if I don't want that the transfer should be considered, the year of transfer should be the year of execution of joint development agreement, or let's say applying Jasbir Singh Sutaria, the year of transfer should be the year in which the possession has been handed over upon substantial upon satisfaction of the conditions as we just discussed about, right, by executing a general power of attorney. So I don't want those particular years to be considered as a year of transfer, because in those cases my capital gain shall be chargeable to tax in the year in which the transfer has taken place, and the developer might be constructing the property maybe within 2 years, within 3 years. So I would be getting my share probably maybe after 2 years and 3 years, but I have to pay tax today. So I am really not comfortable that my transfer should be considered to have taken place today. So what should I be doing? In that case, we need to ensure that my transaction does not fall in section 53A of the Transfer of Property Act. Now please note that. What are the conditions? Once again, I'll take you to the condition. There should be a contract in relation to an immovable property. There should be a contract. Number one, yes, we have a contract. It should be in writing. Yes, it is in writing. It should be in relation to a transfer of an immovable property. Yes, it is in relation to the transfer of an immovable property. Number four, the possession should have been taken by the purchaser. It should be for a consideration, and the vendee, the purchaser, should be willing to perform his part of a contract. So I need to ensure that I am not satisfying all the conditions. If I am not satisfying any one of the conditions here, I can say that my case does not fall in section 53 of the Transfer of Property Act and there is no transfer. Now please note that the law has been amended from 2001, and they say that section 53A would be applicable only if the agreement to sale is a registered. So if I execute a joint development agreement which is an unregistered agreement, then provisions of section 53 is not applicable, and if section 53A is not applicable in that particular case, my case does not fall in the category of section 53A and it cannot be considered as transfer said to have taken place. In that cases, when can we say transfer is said to have taken place? The transfer is said to have taken place when ultimately we execute a registered sale deed, or when we execute a registered deed whereby I get the possession of the developed area from the developer, correct? So that would be a particular year that I would be considered. So technically here I am deferring my tax treatment till the year in which I am getting the possession of my share of the developed property, or I'm getting a possession till the sale deeds are finally being registered, sale deeds are finally being executed. So my indexation will be up to that particular year, the transfer would be up to that particular year. But the problem in this iteration would be that when I go for an unregistered agreement to sale, the developer would not agree, because here the provisions of the Benami law would be applicable. So if you are entering into a joint development agreement, or if you are entering into an agreement to sale, then it must be a registered one, so the developer would not agree to it. Number two. So once again, there is no point discussing this. However, if somebody wants to do this, the direct judgment which is applicable in his case would be judgment of Honorable Supreme Court, where the view has been taken that if the agreement is not a registered one, in that particular case, provisions of section 53A of the Transfer of Property Act are not applicable. The judgment is in the case of Balbir Singh Maini, 2017, 86 taxman.com 94. I repeat, Balbir Singh Maini, 2017, 86 taxman.com 94. So the direct judgment we have in the case of Supreme Court, which says that if the unregistered agreement is executed, then we cannot say that the transaction is complete, or transaction is of the nature referred to in section 53 of the Transfer of Property. But as I mentioned, that the developer may not agree to this. Second is that I have given a possession, but it is a revocable possession. It is not irrevocable possession I have given. I can revoke. If it is a revocable possession, certainly, then once again it cannot be considered as a possession which I have given, and in that particular case section 53 cannot be applicable. But then please note that if it is a revocable possession, once again Why would developer agree to it? Because developer is going to invest substantial amount of time, substantial amount of cost, and if the possession is revocable, he would be in a rather difficult position if the possession is tomorrow fine morning is being revoked. So once again, that is not a suitable or feasible alternative. So this option or this exception even will not work. The third one, can I say that I have not received a consideration? Can I make a statement that I have not received a consideration? So since I have not received a consideration, so that is the reason that transfer is not said to have taken place. Please note that that is not a valid argument here. Please note that the conditions is very clear. The condition is there should be a contract in writing. Yes, we have a contract and that particular contract is in writing. The contract should be for a consideration. So the contract should be for a consideration. Not necessarily it should be accruing to you right now. It is not necessarily it is received by you right now. So simply because the consideration is not accrued to you, that cannot be a ground to say that the transfer has not said to have taken place. We have direct judgment on this in the case of Potla Nageshwara Rao, 2014, 50textmen.com 137, Andhra Pradesh High Court. I repeat, Potla Nageshwara Rao, 2014, 50textmen.com 137, Honorable Andhra Pradesh High Court has taken a view that not necessarily you should have received a consideration, not necessarily consideration should have become due. See, I am discussing this entirely keeping keeping in mind that the land which I am transferring is held by me as a capital asset. We are not discussing the possibility that when I hold a land as a stock in trade, the things can be different when I am holding the land as a stock in trade, because in that particular case, sale is said to have taken place when there is a reasonable certainty of when there is a the property is being transferred. There should be a transfer of the property, not as per section 247 but as per the general law. The property in the goods should have been transferred by the seller to the buyer, and there should be a reasonable certainty of the ultimate collection. The consideration should have become due. If the consideration has not become due, if there is no reasonable certainty, then we may defer the recognition of the revenue. That is altogether a different issue. Altogether the different norms would be applicable. I am talking about a situation when the capital asset has been held by me, land is held by me as a capital asset. In that particular case, once it is mentioned in the agreement that I will be getting certain percentage of the sale proceeds of this arising from the sale of the developed premises, or let's say when the agreement is very clear and the agreement says that I will be getting certain percentage of the share of the developed units, though nothing I'm going to get today, I will be getting in future, but then simply because I'm going to get it future and nothing I'm going to get it today, that cannot be a ground on my part to say that it is not for a the consideration is not received. The contract is for a consideration, so I cannot come out of that. So if it is unregistered one, I can come out, but then not feasible, not the developer may not agree. If the developer agrees, things are okay for you. If I say that if it is a revocable transfer, of course, developer will not agree, so there is no problem. There is a problem. We cannot go ahead with that. The third one is that if I say that condition is not becoming accruing, condition is not accruing right now, it is a future. There is no condition today. There is no consideration today. That cannot be a valid argument in the case in view of the decision of the Honorable Andhra Pradesh in the case of Potla Nageshwar Rao. The fourth possibility is when I say that what I have done is I have not transferred, I have not handed over the possession. I have only given a license. I have only given the license to the developer to come to my property and develop the property. So I have not handed over the possession. I have only handed over a license. And if my agreement is specifying that through this joint development agreement, only a license has been granted, and this cannot be considered as transfer of possession of the nature as referred to in section 2 clause 47 sub clause 5. If that has been clearly mentioned in the agreement, then one can say that I have not granted the possession. What I have granted only license. And when I say that I have granted only license, in that particular case, one cannot say that the transfer has said to have taken place. One has to understand that there is a difference between permissive possession and legal possession. In case of a permissive possession, the developer enters the scheduled property on behalf of the owner and not in the independent capacity of the purchaser of the property. So when we talk about a license, we say that it is a permissive possession granted. We have got direct ruling once again in the case of Balbir Singh Maini, 2017, 398 ITR 531, which says that a reading of JDA in the present case would show that owner continues to be the owner throughout the agreement and has at no stage purported to transfer rights akin to the ownership to the developer. At the highest, possession alone is given under an agreement, and that too for a specific purpose. Mind it, possession is given and that too for a specific purpose. The purpose being to develop the property as envisaged by all parties. We are therefore of the view that this clause will also not rope in the present transaction, meaning thereby they have cleared that in that particular case it will not be regarded as the transfer as said to have taken place because only a permission has been granted. Further, we can say that this decision has been followed by once again Honorable Supreme Court in the case of Sesha Steel Private Limited 2020 215taxman.com 5 Supreme Court, wherein it has been held that where under a sale agreement entered into by assessee for transfer of land to a developer, only permission or license has been granted to start advertising, selling and construction on land. It would not result in transfer of immovable property for the purpose of capital gain taxation. Meaning thereby, when I can say that I have only granted a license and my joint development agreement makes it very clear that I am only giving you a permission to do all those things. I am only giving you a permission to advertise. I am only giving you a permission to sell. I am only giving you permission to market. I am only giving you permission for the purpose of entering my premises for a limited purpose of carrying out the development of the property. It is a permissive possession. It is a license. So in that case, transfer is cannot be said to have taken place in the year of execution of JDA, and the transfer is now said to have taken place in the year in which I get my share of the property. I get my share, I can say, of the my share of the developed property. There I can say the transfer is said to have taken place. One more possibility where I can say that I am moving out of section 53A. If we go to the condition and the last of section 53A, once again let me discuss those conditions. There should be there should be a contract. It should be in writing. It should be now registered. That's what we spoke about. It should be in relation to an immovable property. It should be for a consideration. Under a contract, or by virtue of the contract, the purchaser should have taken the possession, and purchaser should be willing to perform his part of the contract. This is most important. So let us say I entered into a joint development agreement, and the joint development agreement makes it very clear that within a particular time period, let's say within a period of 2 months, the developer has to make an application for change of use of the building. Let's say he has to make an application for getting the plans developed, getting the plans approved, but then in a particular timeline, and let's say he has not done anything out of that. In that case, we can say that the vendee is not willing to perform his part of the contract. Now, please appreciate and please observe that in all your joint development agreement, they give certain amount at the time of execution of an agreement as a refundable deposit. If the amount is given as a non-refundable deposit, or if they are given as a part of the consideration, then technically the vendee has established that he is willing to perform his part of a contract. Then you cannot fall in that exception. So if you want to fall in that exception once again, then you have to ensure that what you can get, what is the amount that you can get, is going to be a refundable deposit. So the amount that you have got is a refundable deposit. It is not at all a consideration that you have received. Since it is a refundable deposit, once again, the department cannot say that vendee has performed his part of the contract. So that's why they say that it is a refundable deposit, but then it will be non-interest bearing refundable deposit. So you need not to pay any interest in the year where, if at all, you have to refund it. And the contract would further say that this refundable deposit will go and adjusted against, let's say, the amount that would be received from the sale of the share of the owner or landowner shares in the developed property. So whenever the landowner shares in the developed property would be sold, and whatever the consideration would come, and that consideration will, that consideration will be set up, or this deposit will be adjusted against that particular consideration. So technically speaking, I have received the advance amount only by executing a joint development agreement, but then I am coloring it, I am shaping it in the form of a refundable non-interest bearing deposit to be adjusted against my share, to be adjusted against sale of my share of the developed property. So by all means it is an agreed amount, but then here by putting it in the form of a refundable deposit, I am saying that it is not a consideration. So because of this refundable deposit wala terminology, department cannot come and say that Wendy has performed this part of the contract. My contract would say that the Wendy or the developer would have to make the would have to seek the permission, would have to make an application for change in use of the building. Let's say my building is residential, he wants to construct a commercial building, so you have to take an approval from the concerned authority for making allowing me to allowing me to change the use of that particular building. If some AMC approvals are needed or municipality approvals are needed, then the approvals are required to be taken. Post that, the plans are required to be developed. After the plans are getting prepared, these plans are required to be confirmed, needs to be approved by me. After that, these plans are required to be approved by the concerned statutory authorities. All those things have to be done, and this is to be done in a particular time frame, 2 months, 4 months, 6 months, 8 months. Let's say this all are to be done within that period. After getting all those things done within, let's say within 12 months, construction should have been started. And now let us say I have categorically provided in my document, in my joint development agreement, that time is the essence of the contract. And let us say that I have executed a contract today. I have executed a contract today, that is 13th December 2022. Today I have executed a contract, but then the agreement says that within 2 months you have to make an application for change in use of building. You have to make an application within further 2 months, that after you need to ensure that the permission is being obtained by 31st of the March. After getting the permission, you once again needs to get the plans ready. Now let us take an example. I have executed agreement today. I have received the refundable non-interest bearing deposit to today. But the developer, Mr. X, with whom I have executed this agreement, he has not done anything. He has not even make an application to an AMC, Ahmedabad Municipal Corporation, or any other concerned statutory body for permitting to, for permitting or for the change in use of the building. So he has not made all those applications. So I can say that by 31st of the March 2023, the Wendy has not performed this part of the contract. So despite I have received refundable non-interest bearing deposit, but then it is not considered as Wendy's willingness to perform the part of the contract. So I can say that I can defer the transfer till the year in which Wendy is willing to perform his part of the contract. But please note that if you want to fall in this kind of a situation, then you need to establish that time is the essence of the contract. And if you can establish that the time is the essence of the contract, then only you can get the benefit of this particular clause. If you cannot establish that the time is the essence of the contract, then in this particular case the things would be different. So we have got judgments, as a matter of fact, from both the sides, wherein they have said that if you cannot establish that the time is the essence of the contract, in that particular case the benefit will not go to the landowner, and they would say that the transfer is said to have taken place today only. You have to establish that the time is the essence of the contract. You can refer Sri Sai Lakshmi Industries Private Limited, the decision of Bangalore ITAT, Sri Sai Lakshmi Industries Private Limited, Text Sutra 297 ITAT, Text Sutra 297 ITAT 2022, right? So and one more decision that you can also refer is in the case of Prestige Estate Projects Limited, 2021 125 Textman.com 127. Once again, that is of in the case of Bangalore Tribunal. So now with this discussion, we have discussed that when a transfer is said to have taken place, the Chaturbud Dwarkadas Kapadia, Dr. Dayalu, they say that if you hand over the complete control over the property and the possession, then the year in which the joint development agreement is executed, that would be the year in which the transfer is said to have taken place. Jasbir Singh Sutaria has said that if simply the approvals, you have simply granted him a permission by virtue of JDA to take various approvals on your behalf. Here, the gentleman is only seeking approvals on your behalf, and in that particular case, it cannot be considered that transfer is said to have taken place. Transfer is said to have taken place when you execute a general power of attorney after he performs his part of the contract. So the transfer is delayed till the year in which you are executing general power of attorney. If it is unregistered agreement, transfer section 53 is not at all applicable. If it is licensed, then section 53A is not at all applicable. In those cases, you would be considered to have transferred your immovable property in the year in which ultimately you get your share in the developed property. So that is what we spoke about the transfer. Of course, indexation benefit will be available up to the year of transfer. Now the next question that comes is, what is going to be the full value of consideration? Now we are aware that we have section 50D in the statute. So section 50D has been inserted in the statute with effect from AY 1314. Now what does section 50D talk about? If we go to section 50D, what does section 50D talk about, which has been inserted from AY 1314? Section 50D says that where the consideration received or accruing as a result of transfer of a capital asset by an assessee is not ascertainable or cannot be determined. Now appreciate the condition. The condition here is that when the consideration received or accruing is on account of transfer of a capital asset by an assessee is not ascertainable or cannot be determined, then for the purpose of computing income chargeable to tax under the head capital gain, the fair market value of the said asset on the date of transfer shall be deemed to be the full value of consideration. So in this case, section 50D, which is applicable from AY 1314, they say that if the consideration is not capable of being ascertained or determined, then the fair value of the asset transfer shall be the full value of consideration. So to apply section 50D, the precondition is that the consideration is not capable of being determined. The precondition is that the consideration is not ascertainable. If the consideration is capable of being determined or the consideration is ascertainable, then in my opinion, section 50D once again cannot be applied, because to go into section 50D, the precondition is that the consideration should not be capable of being determined or it should not be capable of being ascertained. Now, even if we talk about a situation, let's say what will be the situation prior to AY 1314. So the law for prior to AY 1314 was very clear, and they said that in a case when I entered into a joint development agreement, let's say by virtue of executing a joint development agreement, I get 30% of the built up area. I get share of 30% of the built up area. Meaning thereby, I transfer 70% of my land for 30% share in the built up area. Now in that particular case, my full value of consideration is going to be cost of construction of the 70% of the built up area. Sorry, cost of construction of 30% of the built up area. What I'm going to get here is 30% of the built up area by transferring 70% land, because total land, let's say total land is of 100 yards. I'm just giving you a hypothetical example. Or let's say total land is of 10,000 yards. Out of 10,000 yards, a superstructure will be developed, and the 10 floors will be developed. 10 story superstructure is going to be developed. I will get 3 stories out of it. Meaning thereby 3 story and undivided share in the land will be with me. I would be transferring the undivided share in the land super as 7 super land proportionate to the 7 floors. Meaning thereby I am transferring 70% of the land, against which I am getting 30% of the share, 30% share in the developed property. So my full value of consideration would be cost of construction of 30% share in the developed property. Only a developed property, that part, not of the land. 30% cost of construction of 30%, cost of construction of the 30% of the developed structure which I am owning. That is going to be my full value of consideration for 70% of the land which I am transferring. That is going to be my full value of consideration. That is going to be my full value of consideration. Now, please note that we also have to keep in mind section 50C, which says that what I am transferring is land. What I am transferring is land, 70% of the land. So now section 50C says that if the gentry value, if the consideration accruing or received by me is less than the gentry value, then the gentry value would prevail. So the cost of construction of that 30% built up area cannot be less than the gentry value of 70% share 70% of the land. Now the question is how to get the cost of construction. The courts have taken a view that in the agreement, if the parties have agreed that the cost of construction of the 30% amount is XYZ amount, then it would be treated as that particular amount would be treated as cost of construction. Meaning thereby, let's say when I execute a joint development agreement and in the agreement it is agreed that the cost of construction of the 30% of the superstructure would be, let's say, 3 crore rupees. Meaning thereby, it is agreed that cost of construction of the 30% share in the developed property is going to be 3 crore rupees. So my 70% of the land is transferred for 3 crore rupees, assuming the Jantri value of the 70% of the land is less than 3 crore rupees. So if that be the case, then obviously 3 crore is going to be my full value of consideration. Now in that case, let's say actual cost on construction by the developer maybe 2 crore 50 lakh, maybe 4 crore 50 lakh, doesn't make a difference. Since we have agreed that this is going to be the cost of the construction for my share in the developed property, in that particular case, we can say that that particular agreed amount is going to be the full value of consideration. So now this is what has been held, and in the case of Ved Prakash 2012 26textmen.com 166, that is Karnataka High Court. Similar view has been taken in the case of CIT versus Qraj Motors 2015 62textmen.com 304. We also have Hyderabad ITAT in the case of K Vijaya Lakshmi, Hyderabad 2018 91textmen.com 253. In all those cases, they have taken a view that cost of construction of the share in the developed property would be treated as my full value of consideration. So normally when the agreement is being drafted, care is to be taken while drafting an agreement that if I'm getting 30% share in the constructed property against transfer of a 70% of the land, they should mention in the agreement that it is hereby expressly agreed by the landowner and the developer that the cost of construction of or the value of the 30% share in the developed property which is to be handed over by the developer to the landowner shall be, let's say, 3 crore rupees. If it is mentioned, then you need not to prove anything. But then here we have one more judgment of Honorable Karnataka High Court. Actually, what has happened in this case of CPC Logistic Limited 2022 134 textmen.com 197, I repeat, 2022 134 textmen.com 197 CPC Logistic. What has happened in this case? The developer, in order to prove what is going to be the cost of construction, developer has given a simple letter of 1200 rupees or 1500 rupees per square feet. The Bombay High Court said that now we cannot take this particular view. This is not simple based on a letter given by a developer. We cannot take this view. So in that case, though section 50D is applicable for the year subsequent to AY 30, applicable from AY 13-14 and subsequent thereto, but then despite that, they give us the ideology, they give us the hint about the lawmaker's intention to tax. So despite it is applicable from AY 13-14 and onwards, but then this year, though belonging to prior to AY 13-15, the Jantri value will be the full value of consideration. Now, this judgment can be applicable when, let's say, the joint development agreement does not specify what shall be the agreed value of the cost of construction, of the share of the cost of construction that will go to the landowner. If the agreement does not categorically provide, once again the CPC Logistic Karnataka High Court would be applicable. Here I have to take the Jantri value of 7 or the fair value of the 70% share of the land as my full value of consideration. Number two, if the developer is given some base, but then the base is not accepted by the department, or if the base is not scientific, then once again a view can be taken that section 50D would be applicable, and then I have to take a fair market value even if the scenario is prior to AY 13-14. Third situation, let's say when I'm going to get certain percentage of the sale proceeds from the sale. Now when I'm executing a joint development agreement, I really do not know what is going to be the sale proceeds which I am going to get upon the sale of the when the ultimately property is going to be sold. If that is the particular situation, then section 50D would come to the play, because once again CPC Logistics says that the hint of the legislature is available, though it is a year prior to AY 13-14. Now, let us take an example. If the year is post AY 13-14, if the scenario is post AY 13-14, now, I mean AY 13-14 and onwards, even in those cases, section 50D would have an applicability only if the consideration accruing or to be received by the landowner from the developer is not determinable or not ascertainable. If the consideration is determinable or ascertainable, Section 50D has no role to play. Section 50D will have a role to play if the consideration is not ascertainable or not determinable. That's what we just discussed. If it is categorically mentioned in the agreement that the 3 crore is going to be the agreed value of the 30% of the share in the developed property which will go to a landowner from the developer, then definitely that 3 crore will be the full value of consideration in my opinion. And despite Section 50D is in force, Section 50D will have no applicability unless, as I mentioned, the agreement does not specify the agreed value of the cost of construction. They only say 30% of the share in the developed property will go from developer to landowner. Yes, in that particular case 50D would have applicability. They further say that, let's say the agreement says that the property would be sold and the 30% from the sale of the sale consideration will go to the landowner by that will go to the landowner from the developer. In that case, I don't know what is going to be the economic situation. I don't know what is going to be the price that would be having when I execute a joint development agreement. When I'll get the develop the property. So here you can say that the 50D would have an applicability. Otherwise, if the agreement itself is clear, then in my opinion, Section 50D will have no role to play. Now, sometimes we also get consideration in case of a sale of TDR. When we get sale of TDR, now sometimes what happens that a cooperative society is being allotted a TDR for which cooperative society doesn't pay anything. They don't have to pay anything and they are being allotted a TDR. So in those particular cases, whatever consideration arising on account of sale of TDR, since there is no cost of acquisition, it cannot be brought to tax. We have got a judgment in the case of IGE India Limited, 2013, 33 Taxman.com 405, Mumbai Tribunal. We also have a judgment in the case of Jethalal D. Mehta, 2005, 2 SOT 422, Mumbai Tribunal. And we also have a judgment in the case of Land Breeze Cooperative Society Limited versus ITO 2013, 55 SOT 107, right? And that is also of a Mumbai Tribunal. Sometimes what happens that habitable allowance is being paid. Now we can say that habitable allowance is a capital asset, but then what is the cost of acquisition of the habitable allowance? The cost of acquisition of an habitable allowance is not ascertainable or not determinable. So once again, BC Srinivas asset would be applicable, and in case of habitable allowance, once again there cannot be any tax treatment. So we spoke about what is going to be the consideration. The consideration can be in the form of a rent. If the consideration is given to me in the form of a rent, I incur a rent expense because I have to shift to some other place. Obviously, the extra amount that I have over and above what I have spent, right? That would be taxable as income from other source. If I'm not spending any amount because I already have some other house and a rent I keep in my pocket, then this rent income is going to be my income from other source entirely. So this is what kind of a consideration that we can get. Now, one more possibility that comes. So we spoke about a situation where my capital asset is, and I execute a JDA. So I discuss about what is going to be my full value of consideration, what shall be the cost of acquisition. So as I mentioned in the example, 70% of the share of the land, that is going to be the cost of acquisition. That cost of acquisition of 70% of the land I need to take. That is what we spoke about. We also spoke about what is going to be the full value of consideration. We also spoke about what is going to be the year of transfer. We also spoke about up to what year indexation is required to be taken, right? And we also spoke about the capital gain. The capital gain will be there in the year of transfer. अब आपने transfer कब करा? The year in which you execute JDA. आपने का ट्रांसफर कब हुआ? The year in which the possession has been handed over. That could be, by executing general power of attorney. The year in which you got the share in the developed property being a landowner. So we spoke about all those judgments. The year in which the transfer took place, that would be the year in which we can say that the transfer is said to have taken place, and you have to allow indexation will be allowed up to that particular year. That's what is relevant. Now, a possibility is, when I execute a joint development agreement and I take all this care that it is a license or time is the essence of the contract, it is a permissive possession, and on a plot of land, let's say 10 buildings are to be developed. Building A, building B, building C, or you can say tower A, tower B, tower C, tower D, tower E, tower F, so on and so forth. Out of which, let's say I'm given tower E and tower F, and ABCD will be going to be written by developer. Now, department can take a view that, boss, I have converted my stock in trade capital asset into stock in trade while executing a joint development agreement. Because when let's say if I'm getting the consideration entirely in the form of cash, let's say I'm getting entire consideration in the form of cash, let's say I'm getting 5 crore rupees for executing joint development agreement. In that case, there is no problem. It is a capital asset. There is no problem. There is no adventure in the nature of trade. But when I say that I'll be getting 2 towers, as you mind it, let us say when I say that I'm going to get 2 towers, I'm going to get 2 towers A, B, C, D, E, F. I'm going to get tower E, tower F entirely. A, B, C, D will be of the developer. E and F will be sold by me, or let's say the towers will be sold and E and F sale proceeds will come to me. Here, boss, I am carrying out adventure in the nature of trade, and department can very well take a view that by executing this joint development agreement, section 45 subsection 2 has been invoked, and on the date of execution of JDA, my capital asset is converted into stock in trade. So if my capital asset is converted into stock in trade by way of execution of JDA, in that case, fair value of my share, please note that fair value of my share, fair value of the share of the land which I am contributing. I'm contributing 70% of the share for getting 30% of the area. Let's take an example. Or here you can say A, B, C, D, E, F. 5 towers. I'm getting E and F. So technically I get 40% and I am contributing I'm giving 60%. So 60% of my land, you can say that 60% of my land, or you can say, let us say, we can say that 100% of the land has been contributed into stock in trade. Against that, what I'm getting is, I'm getting this particular, my capital asset is contributed into stock in trade, and I'm getting the towers. I'm getting my 40% constructed area is what is being got by, I'm getting 40% my tower. So here, actually what I'm transferring is 100% of my land is being transferred into stock in trade. I'm transferring my entire land into stock in trade, 100%, not 60%. Mind it, there is a difference. If there was a transfer wala story, only 60%. But then here 100% of the land is being transferred into stock in trade, but it would be taxed in the year in which this 2 tower, the 40% premises are being sold. So the fair value would be fair value of what I have transferred is that will become the cost of the acquisition of those particular, obviously that will become that fair market value, that would become the cost of acquisition of those particular flats. Section 45(2) will have an applicability. But let us take an example. In this case, if I say that I have got 2 towers, I have got both these 2 towers, but then I have not sold anything. I have got these 2 towers. I have not sold any flat out of it. I have given those flats on rent to the various officers. Maybe to income tax officers, maybe to banking officers, or maybe to other person on a rent. Now, not necessarily that by executing, now my conduct would say that by executing a joint development agreement, I have not transferred my land into a stock in trade. I still own the land as a capital asset. Whatever premises that I have got, these premises are still capable of being considered as my capital asset because I am not holding them as my inventory. I have got this premises constructed. I have got these houses, let's say 2 tower, 10 houses in each tower, so 20 houses. I have given those 20 houses on the rent, and I am getting rental income on that particular 20 houses. So in future, let's say after 2 years, I sell those 20 houses. In that case, it will be a case of long-term capital gain, and it will not be a case of business income. So as I mentioned that one has to really look into the facts and circumstances of the case. Sometimes department would say that you have executed a joint JDA. By executing a JDA, you have converted your land into stock in trade. But then if I have not converted my land into stock in trade, in my balance sheet I have not passed any entry. Let's say my business itself has got, my business is not a real estate business. I am a healthcare business. I have nothing to do with the real estate business. So simply because I have executed a JDA, that cannot be the only ground on which it can be said that it is going to be a case where I have converted my capital asset into stock in trade. For that, we have a judgment in the case of CIT versus Medavati Agro Farms Private Limited. We have judgment in the case of Global Healthcare. We have got the judgment in the case of Global Health Private Limited, 2021, 131 taxman.com, 58, Delhi Tribunal. Global Health Private Limited, 2021. Right. So here they say that a plain reading of section 45 subsection 2 makes it amply clear that it is the prerogative of the assessee to convert the capital asset into stock. Further, the term business carried on by him necessarily mean that the capital asset so converted must form part of stock in trade of the business carried on by the assessee. In a case where assessee owner of land is not in the business of real estate or relating thereto, and as such, it cannot be said that the assessee by entering into a joint development agreement has converted the land into stock in trade. So the assessee is a global health private limited. It has got nothing to do with the real estate business. Simply by executing a joint development agreement, a view cannot be taken that assessee has executed a joint development agreement. Similarly, I give you one more case. The name which I just spoken wrongly, the name is the correct now case law. I would say the Medavathi Agro Farms Private Limited, Hyderabad IT80. Medavathi Agro Farms Private Limited, 2015, 63taxman.com 274. In that particular case, it was held that while executing a joint development agreement, the assessee has converted his land into stock in trade. So please note that 100% of your land gets converted into stock in trade when you execute a joint development agreement. 100% of your land gets converted into stock in trade when you enter into a joint development agreement. Now, but then this would be taxable when you are selling the particular flats which have been allotted to you. So as per 45(2), tax treatment would be governed. Now we look at a situation. Now in case of an individual, in case of a company, I can say that there is a board resolution based on which it can be said that okay, the land is converted into stock in trade. In case of an individual, how to prove that the land is converted into stock in trade on a particular date? I am not talking about a case where the land is originally held as stock in trade from day one. I am talking about a case where I have hold a land as a capital asset. I don't want to fall into that litigation of transfer. I don't want to fall in the issue of license and all those things. So what I do is I want to say that I have converted my land into stock in trade. So I have converted my land into stock in trade today. Today only I have converted my land into stock in trade. Since I have converted my land into stock in trade today itself, let's say I have got 1000 square feet of land, 1000 square yards of land. Today only I converted into capital asset, stock in trade. So my full value of consideration would be the fair market value on the date of the conversion. So today that is going to be my full value of consideration. My cost of acquisition should be of the 100% of the land. I have got what? My capital gain. But then nothing is going to be taxed today. Why? Because it would be taxed when I sell that particular stock in trade which I have converted. Now, as per the contract, I am going to get A, B, C, D, E, F. I am going to get tower E, tower F, and A, B, C land is with me. Now, here I enter into a contract. I give a possession, but then section 53 has got nothing to do. So, section 2 clause 47 cannot be applied. So, even if I have handed over a possession, irrevocable possession, under a joint development agreement, still it cannot be considered that I have sold a land because it has to be a sale under a general law. Section 53A never means that I have sold my property to a developer. So I have not sold. So please note that land proportionate to tower A, tower B, tower C has not been sold to a developer. So no capital gain. No tax treatment. Capital gain would be there in the year in which I have converted. So let's say I have converted today itself, there will be a capital gain. I have computed capital gain for 100% of the land. For 100% of the land, I have computed capital gain, but no tax liability. Now for A, B and C, now I am executing a joint development agreement. So by executing joint development agreement, once again I am not selling the land. Because section 2 clause 47 is not applicable in the case of a transfer. It is applicable when there is a capital asset. So once again there is no sale. There is no sale. No tax treatment. No business income here as well. So far as tower D and tower E is concerned, once again there is no sale because I'm not selling anything to a developer. I'm simply asking a developer to come and construct. So for all A, B, C, D, E, F, no sale as of now, no tax. In the year financial year 22-23, when I converted my capital asset into stock in trade and thereafter I entered into a JDA, no sale, only capital gain is to be computed. Keep it as it is, no tax. Now let's say 2 years, 3 years down the line, the property got developed. I get my building D, my building E, building F, and the developer gets building A, B and C. Developer gets the building A, B and C. Now when developer gets building A, building B, building C, or at this moment I execute a dastavej with them, here I have sold my stock in trade. So here in this year, in this particular year, the land the capital gain proportionate to that 60%, that is going to be taxed to me. That would be taxed to me. That is going to be brought to tax in that particular year. So, and right, so far as the 40% E and F, that will be taxed. जब मेरे पास वो consideration आया, मेरे पास consideration क्या था? My consideration was this flats. When I sold this flats, तो जो मेरा consideration था, जो agreed cost of construction था, that is going to be my consideration. When I'm selling that particular flats, जब मैं बेच रहा हूँ, उस वक्त मेरा जो business income होगा, let's say I sold that agreed flats for 5 crore rupees and agreed cost of construction was 3 crore rupees. So 3 crore, 5 crore minus 3 crore is going to be 2 crore. 2 crore is going to be my business income. 2 crore is going to be my business income. I converted my stock in trade capital asset into stock in trade in a particular year, let's say 22 23 in our example. The fair market value would be treated as the capital gain. तो proportionate 40% जो capital gain था, वो जब जिस साल में मैंने 40% का stock in trade मैंने बेचा था, उस साल में taxable होगा. जैसे 10% करके 4 साल में बेचा, 10% करके 4 साल में वो tax होगा. This is how we need to consider this situation. So this is what we spoke about, a situation when a capital gain is converted into when a capital asset is converted into stock in trade. But the question is, in case of an individual, how can I say that the capital asset is converted into stock in trade today and thereafter I have entered into a joint development agreement? That is also $1 million question. So for that, we have a beautiful Bombay ITAT decision. One has to keep that decision, Bombay ITAT decision. In that particular decision, what the assessee has done is, assessee has before a notary said that I have converted my capital asset into stock in trade. Assessee has said this before the notary, right, by executing a notarized deed, that I have constructed my I have converted my capital asset into stock in trade. Let me just give me a minute. Let me figure out that decision for you. Let me find out that Mumbai ITAT decision where they have said that construction, or I would say putting it in differently, when I mentioned that by executing a notary, or he said that he has converted capital asset into stock in trade, and the judgment here, just give me a minute, I'll just, yes, that is the judgment in the case of Ramesh Abaji, Ramesh Abaji Wala Walawalkar. I'm sorry, Ramesh Abaji Walawalkar. I'm sorry if I'm mispronouncing the surname. Ramesh Abaji Walawalkar, 2012 24taxman.com 321 Mumbai ITAT. Here, what has happened is, Assess's case was that he converted said plot of land into stock in trade for the purpose of his real estate business. Assessee entered into a development agreement with a builder for construction of flats. Revenue took a view that assessee carried out no real estate business and it was a case of transfer of a land as capital asset simpliciter as per development agreement. However, assessee made an affidavit cum declaration before notary evidencing the conversion of land into stock in trade. Hence, profit or gain arising from the transfer by way of a conversion would be chargeable to tax as income of assessee under the head capital gain in the year in which stock in trade would be sold by assessee. The judgment is Ramesh Abaji Walawalkar 2012 24taxman.com 321 Mumbai ITAT. So we dealt with both the situation where capital asset is converted into stock in trade, you execute a joint development agreement. We also dealt with a situation when I hold land as a capital asset from day one. Now that could be a possibility. I hold land as stock in trade from day one. When I hold a land as a stock in trade from day one, in that particular case, if I execute a joint development agreement, section 45(2) will not be applicable because from day one I am holding the land as a stock in trade. There is no question of 45(2), there is no question of capital gain. When I execute a joint development agreement, I am not transferring any property in the transferring the property or ownership in the ownership of land to a developer as per the general law. I am not executing a sale deed, so section 247 will have no applicability. Even if a transaction is of the nature referred to in section 53A of the Transfer of Property Act, there will not be a transfer. There will not be any kind of a transfer. Since there is not going to be a transfer, there cannot be any capital gain treatment. I mean, there cannot be any transaction, there cannot be any sale. It is ultimately when I sell my developed portion, the share of my developed portion, it would be taxable in that particular year, specifically as a business income only. It may be a possibility that I am a landowner, Mr. X is a developer, we both execute an agreement and we both have a joint venture. Not necessarily a joint venture should be a separate entity. Joint venture may be a separate entity, joint venture may not be a separate entity. I don't want to have a joint venture as a separate entity. In that particular case as well, I don't require a separate PAN. So by simply because I create a joint venture by executing a joint development agreement, once again in that case there is no transfer, there is no capital gain if I hold my land as stock in trade from day one. But if I convert my land which was held as capital asset into stock in trade, the fair market value on the date of the conversion will be deemed to be the full value of consideration. The entire 100% of the land that will be my full value of consideration. And as I mentioned earlier, जब मैं joint development agreement करूंगा, no transfer. Transfer is when I hand over the share to the developer boss. आपका ये शेयर है, इसका मैं आपको अग्रीमेंट करके दे रहा हूँ, आप अपने 60% टावर ए, टावर बी, टावर सी रखो, तब मैंने 60% ऑफ द लैंड बेची है, वो मानी जाएगी. उस वक्त मुझे वो कैपिटल गेन मेरा टैक्स होगा, बिकॉज इन दैट पर्टिकुलर आई हैव सोल्ड माय स्टॉक इन trade. So in that particular case it will be taxable. In that particular case it is going to be taxable to me. That's what we just spoke about. Now we enter into a situation when section 45(5)(a) is applicable. So please note that section 45(5)(a) is applicable from AY 1718 onwards, right? So section 45(5)(a) is applicable, we can say, for the earlier joint development agreement. Section 45(5)(a) is not applicable. Section 45(5)(a) is applicable only from assessment, it is applicable from only assessment year 1819. So it is applicable from AY 1819 onwards. It will not be applicable for the earlier year. Similarly, even for the years assessment years 1819, so financial year 1718 onwards, if we talk about, we have executed a JDA, but then if we are not complying with the condition of the JD or condition of section 45(5)(a), then also the normal law would be applicable to me. Now let's see what section 45(5)(a) provides. It is applicable only if the assessee is individual and HUF. So section 45(5)(a) is applicable to an individual or HUF, meaning thereby the landowner has to be individual or HUF. If the landowner is a cooperative society, company, partnership firm, then 45(5)(a) will not be applicable. Similarly, let us say that if the developer may be individual, HUF, partnership firm, company, doesn't make any difference. The relevant part is that the landowner has to be the individual HUF. Developer का status कोई मायने नहीं रखता. It can be company, it can be cooperative society, it can be partnership firm, it can be anything. The provisions will be applicable. The landowner has to be individual or HUF. Second is capital gain should arise to an assessee on account of transfer of a capital asset. Meaning thereby, the land which I am talking about, which I am owning, or land or building which I am owning, that it has to be a capital asset. It should be held by me as capital asset. Meaning thereby, if the land is held by me as stock in trade, 45(5)(a) has no applicability. If the land which I do have is a rural agricultural land and it's not a capital asset, since it is not a capital asset, 45(5)(a) will not be applicable to me. Land has to be a capital asset in my hands. If it is a capital asset, then section 45(5)(a) will have a role to play. In section 45(5), so land has to be a capital. And second, there should be a transfer of a land. Meaning thereby, if I execute a joint development agreement and if I once again try playing with that license and the possession, in that particular case, once again I can be in a soup. I need to ensure that the transfer should have been taken place by executing a joint development agreement. My case must fall in the category of Chaturbud Dwarkadas Kapadia and Dr. Dayalu. My case should not be falling in the category of that license wala story. My case should not be falling in that case where the time is the essence of the contract. I should not have attempted of deferring the year of taxability. So the clause that section 2, it will not be treated as transfer under section 2 clause 47 subsection 5. This kind of clauses should not be there in the agreement if you want to fall under section 45(5)(a). If you enter such kind of clauses, in that case you are moving out of section 45(5)(a), because that the agreement should be executed by individual HUF, landowner should be individual HUF, there should be a transfer of a capital asset, so there has to be a transfer. But when you enter this kind of, make this kind of clauses, there is no transfer. Similarly, the agreement should be a registered agreement. If the agreement is not a registered agreement, once again section 45(5)(a) will not be applicable to the assessee. The capital asset is a land or building or both. So basically the provisions of the section will not be applicable in case of a rural agricultural land. As I mentioned, the capital asset has to be either a land or a building, but then it has to be a capital asset. The transfer is made under a specified agreement. So we know that what is a specified agreement? Specified agreement means a registered agreement. It has to be mandatorily a registered agreement. If the agreement is not registered, it cannot be considered as a specified agreement. Further, they say that the specified agreement means a registered agreement in which a person owning land or building or both agrees to allow another person to develop a real estate project on such land or building or both in consideration of a share being land or building or both in such project, whether with or without payment of part of the consideration in case. Meaning thereby I should be getting some share in the developed property. If I am not getting any share in the developed property, I am getting only cash. I'm sorry, I am not followed by 45(5)(a). I should be getting some share in the developed property. I may be getting some share plus cash, no worries, but then I should be getting at least some share in the developed property. Then only I would be covered by section 45(5)(a). Otherwise, I will not be covered by section 45(5)(a). The next issue is that the assessee has not transferred his share at on the project owner before the date of issue of the certificate of completion. Now, if I have transferred my share on or before the issue of completion certificate, then once again, these provisions will not be applicable to me. I'll be covered by the normal share. I'll be covered by the normal provisions. Please appreciate that the word is his share. Meaning thereby, if I execute a land development agreement, a joint development agreement, wherein I am transferring my entire share to someone else, then this provision will be applicable. So if let's say my share in the constructed property is 30% in consideration of 70% of the land, my share is 30% of the developed property, and I transfer 50% of my share to someone else, my share is partly transferred. It will not be I will not be escaping from this. I will be escaping or I will be thrown out only if I am transferring the whole share. Because here the word that I should not have transferred his share, the assessee should not have transferred his share. They have not used the word assessee should not have transferred his share in whole or in part. So if assessee has not transferred his share, meaning thereby his entire share if I have transferred, then I will be falling by the normal provisions. Then I will not be covered by this particular provisions. Now please note that here what they are saying is that I should have transferred, meaning that my capital asset must have been transferred while executing an agreement. So my transfer is said to have taken place in the year in which JDA is executed. My full value of consideration is going to be the jantri value of my share in the developed project. Jantri value, and it will be taxable in the year in which the certificate of completion is received for whole or a part of the project. So once I get the certificate of completion in that particular year, whatever may be the jantri value, because it's the year in which I got the certificate of completion, I would be having the jantri value of my share in the developed project. That is going to be the full value of consideration for the entire land which I have transferred. Now please note that if I am getting 40% share in the developed property against transfer of 60% of the land, no, I am transferring 100% of the land and I am getting 40% share of building and land both. So that is what the interpretation. So my full value of consideration is going to be 40% of building plus 40% of land, and the jantri value will be that my cost of acquisition is going to be the 100% of the cost of acquisition of the land which I am transferring, and indexation will be only up to the year of JDA, but it will be taxable in a particular year in which the completion certificate is received. So that is what section 45(5)(a) provides. In a case of a normal provisions, as I mentioned, I am transferring only 60% of the land against 40% of the developed property. So full value of consideration would be going to be the cost of constructions. If it is specifically agreed in a document, then for cost of construction, agreed value of the cost of construction or agreed amount of value of construction of the 40% share would be the full value of consideration for the 60% of the land transfer if the matter is prior to AY 1314. If the matter is after AY 1314, then also in my opinion, if the agreement provides that specific value, that would prevail. If not, then 50D would be prevailing. But if I want to covered under section AY, covered under section 45(5)(a), which is applicable from AY 18-19, that is financial year 17-18 onwards. In that particular case, full value of consideration in the developed property, that is 40% of building and proportionate land, would be my full value of consideration. My cost of acquisition will be of 100% of the land. I'm transferring entire land and I'm getting 40% of the property. So that is the difference that we need to consider. Over there, as I mentioned, the agreed value of construction, or agreed value of 40% share of the superstructure, that is full value of consideration over there. Here, my 40% gentry value, not agreed value of construction, now in 45(5)(a). Here, 40% portions gentry value, building and land both, that is full value of consideration. Cost of acquisition over there was only the cost of acquisition should I take only of 60% of the land, because that is what I am transferring. Here in 45(5)(a), 100% of the land is being transferred, so cost of acquisition of the 100% of the land I need to take. You would say that what is the difference? आप वहां पर 40% लैंड बिल्डिंग दोनों ले रहे हो फुल कंसीडरेशन, यहाँ पे 100% कॉस्ट ऑफ एक्विजिशन माइनस कर रहे हो, अल्टीमेटली एक हुआ सर, एक नहीं हुआ. वहां पर मान लो मेरे पास फ्लैट आए और वो फ्लैट मान लो मैंने 6 महीने में बेच दिए, तो फॉर अ फ्लैट इट वुड बी अ शॉर्ट टर्म कैपिटल गेन, बट फॉर अ बिल्डिंग इट वुड बी अ लॉन्ग टर्म कैपिटल गेन. Here if I sell the flats, then for land and building both it is going to be a short term capital gain. For a land I can go and claim benefit of section 54 or section 54F as the case may be, but here I cannot take the benefit of 54F when I sell that particular flat, because now it is entirely going to be a short term capital asset. So that is what is to be taken care of. So with this we have dealt these possibilities from all the angles, all possible angles, as I mentioned. We can say that 45(5)(a) prospective or retrospective, we have got Amit Vishnu Prashankar 2021 131 taxman.com Pune Tribunal. They say that these provisions are not retrospective, they are prospective. We have got Hyderabad ITAT as well taking the similar view. So with this, in this video we discuss about all possibilities in case of joint development agreement. Of course, development agreement in the from the purview of the land owner. We have not discussed from the developer's point of view, but then we have discussed this from the angle of land owner. All possibilities we have discussed. We have discussed that what if the capital asset is held as land is held as capital asset, what if land is held as stock in trade. We have discussed that what if the land is held as capital asset which got converted at stock into stock in trade before executing a joint development agreement, and the relevant judgments. We also talk about a possibility when the land is held neither as capital asset nor as stock in trade, it is a rural agricultural land. We spoke about the situation under section 45(5)(a) before and after. We also spoke about in this discussion that what would be the full value of consideration when 45(5)(a) is applicable, when 45(5)(a) is not applicable, when 45(5)(a) is not applicable, before 50D region, after 50D region. All those issues we spoke about. Friends, whatever we discussed, they all are my personal views. Before you execute a joint development transaction, you please make sure that you get it vetted from your concerned consultants, so that you don't end up paying unnecessarily an extra amount of taxes. Further, you don't end up entering into unnecessary litigations. I'm sorry, I forgot to discuss one point, that if I held a capital asset as rural agricultural land, then what? So if I held capital asset as a rural agricultural land, then I must ensure that I execute my agreement in such a fashion that while executing a joint development agreement itself, a transfer is said to have taken place, so that I can take a stand that what I have transferred is a rural agricultural land, it is not a capital asset. Of course, department would litigate saying that you have the moment you execute, you cannot execute a joint development agreement without getting the land converted into an NA, and the moment the land gets converted into an NA, it becomes a capital asset and capital gain tax would be applicable. So to come out of this, we have got a direct judgment in the case of Ananda Rao, Karnataka High Court Ananda Rao judgment. I have covered that judgment in my separate video. wherein it has been categorically been provided that despite the land got converted into NA, let's say in a particular year, and after 2 years of getting it converted into NA, that particular land was sold. But since the land was continuously being used for an agricultural purposes, it was held that it is going to be an agricultural land only. So even for the purpose of executing a JDA, you convert the land into an NA, but by the time the gentleman takes necessary permissions and the approvals, and by the time you execute a you hand over a possession, if the land is being continuously used for the agricultural purpose by you, once again, to my mind, you may fall in that particular case, and still you can avoid payment of taxes while executing a joint development agreement in that particular case. So friends, I tried cover almost all possibilities with respect to the tax treatment on joint development agreement from the landowner's point of view. I hope you would have enjoyed this, and it would be of some benefit to you. If you have any doubts, queries, suggestions, please feel free to share the same with me. Thank you very much. Wishing you all a great time ahead. Thank you very much and take care.